Hi, I'm Roger Daniel, president and founder of Daniel Management Group, and I'm here with Sam Miller, KeyBank, fellow UW grad, and we just wrapped up a panel at BizNow's annual multifamily conference, and just wanted to kick it around a little bit with Sam and ask, how are things going on the lending market, financing market? How would you kind of sum things up?
Yeah, I think, we started the year Q1 really optimistic. It felt like there was a ton of activity. The Treasury had dipped below 4% at the end of 2023. So we saw a lot of momentum in Q1, which was great. However, I think we were expecting, 3 to 4 rate cuts at that point. So things have gotten a little murkier as the year has gone on. The Treasury volatility has really been a number one factor in a lot of this. We've seen extreme volatility in the 10-year, and really we're expecting that to taper off. There has been also some shifting. We now know that the Fed is planning on cutting rates only once this year, ideally in September. So I think kind of coupled with all that, we have seen some slowdown. However, there is really some true opportunities coming out. The acquisition market is certainly better than it was last year. So it feels like there's some optimism looking towards the end of next year, or the end of this year and early next.
What types of assets are attracting the most attention from KeyBank now, given the current circumstances in the market?
Yeah. I mean, what we're seeing is a lot of investment kind of back towards the Midwest. A lot of our clients who owned in Florida and some of the Sunbelt states are struggling and really selling a lot of those assets for a variety of reasons. I'd say insurance premiums are really one of them. So we're seeing a lot of demand in the Midwest. Our cap rates never got too low, so we really are seeing the deals make sense here. I think another piece is we're seeing a lot of demand for shorter term fixed rate debt. That is traditionally agency paper, 5-year fixed rate. So have been doing a lot of that business. And then on our balance sheet, we're seeing a lot of demand for kind of a bridge to bridge product. So there's a lot of opportunities now that are in lease up and need, 18, 24 months to stabilize or some time to work through a tax appeal. And so I think those opportunities we're really seeing on the balance sheet side of things, with the hopes that you can put on some short-term fixed rate or floating rate debt to kind of weather you through this cycle and really capture low rates again in 3 to 5 years.
And we just wanted to see how existing loans are holding up.
Yeah, I'd say our portfolio at KeyBank, we are primarily a multi-lender. So on our balance sheet, 60 to 70% of our debt is multi. The fundamentals are still great in the multifamily space. We've seen rent growth, although moderate, it's still there. Operations have been steady, so our multi-portfolio is great and has been holding up. Really, we're seeing distress in the office market globally. KeyBank doesn't have a ton of office exposure, so we do feel good there. We are one of the largest servicers, both for our own book, but also third party. So compared to, I think in the last 2 years, we've seen our special servicing book increase 160%. So I'd say at Key, we feel okay, but globally, looking at this special servicing, I think there is some distress kind of coming. A lot of that is obviously office. We're seeing some of it in hospitality, but there is some multi as well, some, shorter term floating rate where they were projecting 15, 20% rent growth, and they're not getting that. So I think that there is some distress on the market overall, and we'll see kind of how that plays out in the next couple of years.
Great.
Thank you.
Thanks so much.
Thank
Pleasure
you so
meeting you.
much.
Great job on the panel.
Thank you. Thanks.